In this video, we're going to be looking at gold and its 40-year cycle. Here's a long-term price chart of gold going back to 1838. Very difficult to see any cycles, although it does look to be kind of stair-stepping. The problem is that we're measuring gold in US dollars. We're measuring gold in fiat, which really is backwards because gold is the measuring stick and fiat is a terrible measuring stick. So we're measuring a good money with a bad money. So it's really hard to discern a predictable cycle here. So what we're going to do is we're going to take various assets and divide it by gold as it should be. All right, here we have the Dow Jones divided by gold, going back to prior to 1900. So we have a very long-term chart here. Now we're going to start by estimating the cycle length because there appears to be a very clear cycle here. So I measure from peak to peak. We got about 37 years. This is a 12-month chart, by the way. Got about 35 years. Got about 43. So on average, it looks to be about a 40-year cycle. So I'm just going to say 40 years. Okay, so then we take a simple moving average that's 1/4 of the wavelength and offset it by 1/8 of the wavelength. So we have a 10-year moving average offset by 5 years. That gives us the smoothest, the best signal clarifying price that we can achieve. And you can see what that looks like here. And so it appears that there's a pretty darn clear 40-year cycle, or very close to it. So then we can take that cycle and sort of extrapolate it outwards. If I take the bottom of this cycle, and I'm measuring from the roughly center of the cycle bottom and not the nominal bottom. In this case, they might be the same. And I measure out about, it actually is slightly less than 40 years. I think it's like 38 or 39 years. And then I just draw in that approximate cycle load there. And I do the same with the peak. So that's a pretty rough, reasonable estimation. We had a bottom in gold around 2000. And we had a very early peak in gold in 2011 relative to stocks. Now, that nominal peak in 2011 was about 8 years too early in the 40-year cycle. And we had actually a bounce when we should have had a trough in that cycle. So generally when you see something like that, I would expect sort of conservation of energy. So I would expect another basically late, in this case, peak in gold or trough in stocks. And we're kind of getting that now as gold is rallying pretty hard and stocks are kind of sideways. What I might expect in looking at a chart something like this would be, since we had a peak that was 8 years too early, maybe we can expect another peak or trough that's 8 years too late, which would give us somewhere around 2027, a low in the Dow gold ratio, which would imply maybe another 2 years of gold rally or 2 years of stock crash. Now, that's not to say that that has to happen. We could also just kind of see the ratio do this for a while to conserve that energy. You could kind of just chop sideways and then take off later in the cycle. Something like this, maybe. Point is, if you had to choose between stocks and gold, right now it looks to be more favorable towards stocks. In this chart, we take median household income in the U.S. as measured in gold, and we see that median household incomes are about as low as they've been in recorded history, with the exception of a wick back in 1980. Which was also a gold peak. And I had to mine the data prior to 1984, So wherever you see one of these, I don't know why that's orange, but the green bar represents the average price every 5 years. So it's basically one data point every 5 years. So it's not very granular data, but surprisingly, it does illustrate the fairly clear cycle. Now I can't use my signal clarifying simple moving average on this data, but you can pretty clearly see the various highs and lows. So we've got one here, again, about 43 years, pretty close to that 40-year cycle. We're seeing another one now, pretty close to that 40-year cycle. This is telling me that the 40-year cycle is pretty intrinsic to gold. Now, what this is also saying is that if you're the median or average household in America, your income buys the least amount of gold in U.S. history. And that jives with kind of the word on the street, right? Wages right now are incredibly low. People can't afford housing. Wages have definitely not kept up with inflation the past few years. Very interesting here. This would suggest to me a peak in gold because nobody's bearish gold. Everybody's bullish gold. So it jives on both the word on the street with income and gold from a sentiment perspective. Now I'll just draw this in as kind of a rough estimation of that cycle. Similar pattern here where we had an early peak in 2011 and now we're experiencing a late cycle peak in 2025. This would suggest to me a very rapid reversion to the cycle because now the cycle is moving upward and the nominal ratio is diverging in the opposite direction. This suggests a pretty rapid and steady move down in gold and up in wages. If I do the same thing with median home prices in the U.S., we can also see a very, very clear cyclicality. We've got our signal clarifier here, and you really don't even need one for this data here. I was a little skeptical about the reliability of my data, but after having seen how clearly the cycle holds up, even though I can't guarantee any single data point, the trend is very, very clear. And this would again suggest to me that gold is peaking. Now, could gold come down further, do something like this? Yeah, I suppose it could, but you have to weigh your risk reward, right? So in this case, this ratio would suggest that buying a home would be a better investment than buying gold for the next approximately, we could expect another peak in approximately the late 2030s. So that gives you a good 10, 15 years to invest in a house and not in gold. If you have gold, trade it for a home. That's what this ratio is suggesting to me. Again, very interesting how that 40-year cycle in gold shows up in all these various ratios. Now, we looked at income and we looked at housing. What happens if we take housing and divide it by incomes? We don't really get that 40-year cycle disappears. Now, what do we get? We do get, at the very least, an upward trend that looks like this, meaning housing is getting more expensive relative to the U.S. household incomes. That's a very interesting trend, and it makes you start to ponder, well, what factors would cause this to roll over? Would onshoring of U.S. jobs raise incomes relative to housing and help to stabilize or reverse this trend? I don't know. This trend's been going on for 100 years now, but that's outside the scope of this video. This is just to illustrate that 40-year cycle seems to be built into gold. Now we can look at the U.S. GDP as measured in gold, and this one's a little bit less clear about what's going on because You can see a bit of a peak here, maybe in the early 1920s, maybe a trough in 10s and 30s, but it's a little bit hard to tell. What is fairly clear is that we had this peak in 1970, peak in US GDP or low in gold, and a low in gold in 2000, 2001. So that's about a 30-year cycle there. If we measure from 1980 to here, we see that 40-year cycle show up from between those troughs at least. If we measure backwards from 1980 to this low, that's about our 40-year cycle, pretty close. So that 40-year cycle seems to hold up here as well. However, it's a little bit unclear what this trend is. Is it kind of curving? What's going on there? Not entirely sure, but I would still be fairly confident that we have at least a peak in gold at this point. Can we do something like that? I don't know. Maybe something like that. That doesn't quite account for this peak, so that's a little bit harder to at least tell the channel. But the peak in gold seems to be fairly clear. We can also measure federal public debt divided by gold, but this one is a little bit crazy. And some of these lines I have on here go back to the presentation that I'm working on, which is the full introduction to the wealth cycles concept. Now, this is public debt to gold ratio. We saw a huge peak in debt during the Civil War, followed by basically zero debt in the late 1800s to early 1900s. And then once we got off of the gold standard around 1913, that's when debt really started to increase dramatically. And this larger arch here goes back to the empire cycle, or sort of the civilizational, at least U.S. empire cycle, which is really a function of debt. And that's what this, where the black line is showing the overarching arc of U.S. dominance, so to speak. So we may very well be at peak U.S. Debt. Now, the 80-year debt cycle is shown in red. And you can see that when the debt cycle was low, we basically had zero debt. That converged with a peak in gold. This blue line is actually the inverse. So this means gold's high and debt is low, which is why we had no debt at that time. And now we're at a point in history where we are at peak debt cycle, 80-year debt cycle, and a peak in gold. Round about the year 2058 or so, we'll have a trough in the debt cycle and a peak in gold, which should really help move toward paying off the national debt. And I would expect this ratio to continue to decline well into the year 2100, but that's sort of beyond any of our investable scopes. It goes to show that there looks to be a peak in gold. Here we have feeder cattle divided by gold, feeder cattle priced in gold, and we can see that cattle are relatively low relative to gold, or gold is relatively high compared to cattle. And if we follow that 40-year cycle in gold, we could expect some kind of low in gold or peak in cattle in the mid to late 2030s, although this cycle is a bit less clear. And that's what that looks like, although we've diverged a bit here recently. That should correct when gold starts to fall. Now, what is a reasonable price target for gold in dollar terms? That's a harder question, because dollars are a very poor measuring stick, and so we should really be measuring assets against assets and really only be involved with dollars as a transitional tool or during moments where liquidity has dried up. And this is sort of my liquidity oscillator that I use to tell when liquidity is relatively high or low. Right now we're relatively low, but not necessarily at extremes. We'd been at extremes recently. Presumably we're on our way up, but we don't know for sure. The best time to maybe cash out and hold dollars is when this oscillator is near the top and your dollars are worth a lot more to buy assets down in this region. So this can kind of assist you in telling you when you should be a little bit over or underweight dollars. Most of these charts suggest to me that $3,500, which we did peak at, is a very reasonable target. I would definitely be fading out if I had any gold. This could theoretically go higher in a blow-off top, but let's just run some numbers here. Let's go to median housing divided by gold. Some people are calling for $10,000 an ounce gold. Okay, if that's going to happen within the next year or two, that means gold is going to have to triple. So right now, median housing in the U.S. is, we'll just say $420,000. $420,000. And if gold goes to $10,000 an ounce, that gives us a ratio of 42 ounces of gold would buy a home, in other words. That would put our ratio right here. Does it seem reasonable for this to happen? I mean, this is a very clear channel trend line, and I'm not saying this can't happen, but I'm saying what are the odds that this happens? I mean, this chart goes back through world wars, Great Depressions, and everything in between. Are we really going to be the exception of the rule this time? I would never rule anything out, but if you're just trying to manage risk-reward, right, your risk of gold going down is much higher than your potential reward of this happening. The probability of gold going down is much higher than the probability of gold completely busting out of this very clear historical channel. All right, so if housing is $420,000 divided by $5,000 gold, that's 84 ounces to the home. So that seems within the realm of possibility. But I would argue that given we had this sort of prolonged double bottom, that kind of dampens what the nominal price action can do, because when the nominal price action aligns with the center of the cycle, idealized cycle bottom, that's when you can really get a sharp peak like you saw here in 1980. The nominal peak lined up right in the center of the idealized cycle peak. In this case, we had an early and a late bottom, which to me dampens the possibility of an extreme move to something down in this range, anything above, 5,000. Here's another one where we have oil divided by gold. The 40-year cycle doesn't show up quite as neatly in oil, but what this does show you is just how extremely cheap oil is relative to gold. So is gold going to go much higher? I mean, look, we saw this crazy stuff in COVID, so where oil went negative, so who knows? But I'm just saying this chart goes back a long ways, and we haven't really broke out of that range to this degree in the past for very long. So the bigger risk is in downside to gold. The risk of gold going down is much higher than the risk of missing out on more gold upside. Don't get greedy on these big moves like this. Even if you're a gold bug, fading out on these big moves. And I hope the relative valuations and signal clarifying moving averages helps you see things a bit more clearly as they have done for me. This is Wes-tone with Wealth Cycles. check me out on X, and good luck out there.